Did you only think that the only way to compound your money with Covered Call ETFs is through contributing or reinvesting and repeat the process over and over again? But there is a third way in which you can compound your money that requires no extra work on your part. That's right, no contributions, no reinvesting whatsoever. It's like getting a raise in your regular day job. So I'm going to show you all how you can identify Covered Call ETFs that give natural distribution raises on a regular basis, how to identify them. Let's go in our Wayback Machine and figure out which geographies, which sectors, which kinds of funds actually raise their dividends on a fairly regular basis. Now, just remember, raising distributions is never a guarantee, but we can get some clues from what you're about to see in this video. So let's hit it right now. All right, everybody. So for the natural distribution increases that we want to unpack, discover, figure out which sectors have risen the most in this very short period of time, we're going to be looking at 2024 as our full year example. We are going to go into a tool that I've created to do just that, which is the Covered Call ETF AllStar tracker for all of your Covered Call ETF needs, 300 plus funds. And you can access it for yourself in the description below. So check out those details for yourself. Lots of tabs in here. I can guarantee you it did not look like this when I came out with this a year and a half ago. It was just one tab. The Canadian tab probably only had like 50 funds in there at the time. But yeah, over 300 now and way more tabs, especially with tax info, distribution increases, yields, an American tab. You can also follow my portfolio here and some resources. So even if you use it, you can also watch some videos, very short, 1 to 2 minute videos on exactly how to explore the tracker for yourself and some other tools when it comes to taxes and portfolio tools as well. But for our purposes, let's go into the distribution tracker. And what we're going to be doing here in 2024, we are going to be highlighting the entire column to see exactly on average what was the distribution increase across the entire Covered Call ETF landscape. And what do we have here? We would right click right on the bottom and then drag it up all the way to the top. And if you're accessing this for the first time, you might need to change it. You might see sum in the bottom right hand corner. Just click on it and change it to average here in Google Sheets. And what do you see? The average is 20.33%. An incredible increase across the entire Covered Call ETF landscape. Now, I don't know about you, but I started out as a dividend growth investor of sorts. So from my understanding, or at least limited understanding of dividend investing, hey, if I could get 10% increases from my dividend stocks or ETFs, that was considered incredible, absolutely amazing. So the fact that we're actually getting 20% from a lot of a mix-matched hodgepodge bunch of index funds, single stock, Covered Call ETFs, sector Covered Call ETFs, it is quite the mix of different kinds of strategies, even here from what we can see in 2024. So if it averaged 20.33%, we can actually go into the region column. And what did we get from Canadian funds? Now, Canadian funds might not necessarily just invest in Canadian stuff. They'll also invest in American stuff as well. I would argue that a lot of these Covered Call funds invest much more in the United States than they do in Canada. But let's go through the exact same exercise. And what do we have here? 10.12%. That is still a great number. I'm very happy with that. Very happy with that. And if we move across, we're going to also see a bit of a breakdown as to just the distribution changes in general. You're seeing some red, a little bit of green, but I can promise you this, once we look at the American stuff, it bounces around like crazy. Of all of the big 7 Canadian Covered Call ETF issuers, they typically opt for a more stable strategy. So they lock in their distribution, try to pay out basically the same, which I really appreciate. If I'm going to be living off of these, or I plan to live off of these, I really want to be able to plan around a centralized distribution that can be maintained. Ideally, it can grow over time. I'm not banking on it, but it's kind of a nice bonus when it happens. So going through an exercise like this, using the tracker to identify the sectors that pay out the most, or at least raise their distributions on a more average basis, can certainly help to plan for that retirement or live off of these covered call ETFs of sorts. Now, like I said, contributions, reinvesting, those should be kind of in the psyche as the main driver of how you're going to build up your covered call ETF wealth, but doesn't hurt to also factor in those natural distribution increases as well. So we got 10.12% for Canadian funds. On the American side of things, what do we have here? Well, like I said before, we'll go to the bottom, click on it, drag it all the way to the top, and the average is a whopping 44.35%. But that number is not for the faint of heart. Why is that? So let's drag across the tracker here. And what do you see? A lot of red, less green, a lot of bouncing around. You can see over here, we're getting a lot of yield max type stuff. Let's just kind of go mid and see what else we get. So again, on the American side of things, it's much more variable in nature. So I mean, again, if you're planning to maybe live off of these things, the American side of things is much more erratic when it comes to this sort of thing. But nonetheless, it's up 44.35%. I think a lot of this is just due to the fact that you get much more single stock covered call ETFs on this side of things. So single stocks are naturally, once you concentrate everything down to the most minute single thing, the potential for outsized yields, outsized price performance is really at its peak at that point. Once you start diversifying, you really are tamping down the potential upside, but you're also mitigating that downside potential as well. So that's what you typically get when you diversify the portfolio. So we got 44.35% versus 10.1%. Let's go back to the Canadian covered call ETFs, and let's try to figure out what sectors have been raising them the most. So in my mind, what I think we need to look at is technology. It is by far, in a way, probably the most important sector to a portfolio, especially a covered call portfolio, if you're going to be relying on growth. If you are bullish that, hey, markets, they've been going up for 150 years, 200 years, they're still going to go up. If you're investing, I take it you're bullish that the markets will continue to go up. You wouldn't invest knowing that markets are just going to go into oblivion no matter what you're invested in. So we got 22.31% for funds out of Canada that invest in the technology sector, 22.31%. And we go across the board here. It's quite light when it comes to the red. You probably have a little bit more green in here as well, but overall very stable. So you see a lot of, if you go to the month over month changes, a lot of 0%. Nice and steady. I like to see that. But for the fun of things, let's compare Canada to the US as far as technology is concerned. All right, let's try this again. Go to the top. What do we have? 42.79%. Doubling up the Canadian technology centric covered call ETFs. But once again, you're going to get a lot of variability in those distribution increases and decreases as well. So heading back over to the Canadian side of things, let's have some fun and look at some other sectors. The biggest one in Canada, as far as our version of the S&P 500, the TSX 60, where technology dominates the S&P 500, dominates the NASDAQ. Up here, it would be financials. So let's see. What do we get with financials? Very curious to see what this is at. It's at 21.74%. I'm actually kind of surprised by that it is almost as high as the technology sector. But what can we get out of maybe, say, something like utilities? Let's try that one on for size. And again, not as plentiful as financials and technology, but still you're getting a nice increase from a steady Eddie boring sector like utilities. Another sector I'm sure many of you are curious about, especially if you're Canadian, is the energy sector, as financials, energy, utilities dominate the home bias when it comes to our investments. Oh boy, what do we got here? It's going to go negative. That's what it looks like. Negative 7.74%. Okay, so energy, I mean, as far as distribution increases are concerned, it's really, though, dominated by NXF, NXF.BE, NXF.U. Those are the big culprits for the reason why this is driving down. But if you took that out of the equation, it's basically flatline, okay, negative 0.1%. So really nothing in particular. Okay, so we've looked at energy, we've looked at utilities, we've looked at financials. Let's look at the all-in-one ETFs. So these would be maybe a mix mash of indexes. This might be, basically these are funds that touch all aspects of the economy, whether it be the global economy or the North American economy or just the US economy. Okay, we got on average, I mean, ZWQT is really busting the chops here. As far as the average is concerned, only up 1.03%. But let's just take that out of the equation as ZWQT. Sorry about that, pal, but not the most popular fund going. You get an average of 11.04%. And I would say BMAX, HDIV, HYLD, and HDIF. These are newer players. They have some bonds in them. But I would say BMAX, HDIV, HYLD, HDIF have been sort of the main all-in-one staples. And hey, the fact that you're getting, what is that? On average 11.04%, right in that nice top-end wheelhouse as far as, or the average wheelhouse that we want to see distributions increasing by. Now you might be wondering, how can distribution increases occur? Now this typically happens with portfolio coverage. When a fund, let's say we have a unit, an ETF, a Covered Call ETF with a share price, or I should say unit price of say $100, and the ETF issuer puts in their prospectus. They're saying we're only going to write call options on 50% of the portfolio, meaning the other 50% is unbound. It can do as the market does. Okay, so they say on 50% we're always going to write. That's what we're going to do. So as let's just say XYZ Covered Call ETF moves up in value, goes from say $100 to say $200, and imagine they're still writing on the same amount. They're still writing on whatever that first share price was when it was back at it. They're still writing on, again, 50% of the portfolio as if the share price was still $100, which means currently they're writing on 25% of the portfolio. Now what they can do is they can up the coverage. They want to get back to their 50% mark. So they go to $100 now that the unit price is at 100. So with a bigger increase in unit price, again, the portfolio coverage expands and becomes 50% of that new $200 mark. Now they're going to be raking in even more premium. So this is really at a base level understanding of how natural distribution increases work. So opting for a stable strategy, funds that can kind of naturally grow over time. You can, I wouldn't say bank on it, but it is of my confidence that I am at least leaning towards the understanding that there is a much stronger possibility that an ETF can, well, more specifically, a Covered Call ETF can grow its distribution naturally over time, as long as you're allowing that portfolio to have some natural growth in there as well. Anyways, for the purposes of this video, I think we've looked at and covered a lot in here. Again, you can discover a lot of this stuff for yourself, more information than you could possibly have at your fingertips for your Covered Call ETF research. Give it a try. And head over to the distribution tracker so you can check this out, filter it for yourself. If you're wondering how to filter it, seeing as how when you guys go to look at it, you're going to be in a read-only version, just remember to highlight the whole row, which is that top row here. You want to just highlight the whole row, go to data, and then click on create a filter view, and that's going to give you these filter options at the top there. But you also have that option of showing how to do it in the resource tab as well. So that is it for this video. Hopefully you all enjoyed seeing how natural increases can occur, building a portfolio that will can allow for those natural distribution increases. You get a little bit of food for thought. This is something that is fairly actionable right away after watching this video that you can now think about. So with that being said, hit all the buttons of the like and subscribe variety, and I'll see you all in the next video.